Good morning, everyone, and welcome to the European crossover webinar. And what a morning or early morning in Asia into European morning it's been. We've seen phenomenal moves, not only in equities, but actually in FX. I'd almost have to venture that to say that the moves in FX have been far greater to a certain extent, as we've seen the dollar yen come tumbling all the way down to a 101 handle, euro almost to 115. I mean, we've seen some huge moves. Look at the moves here in Aussie dollar. Just unbelievable moves. Cash dollar has even slid all the way down here with a 94 handle. It's just been some huge, absolute huge moves. I guess we can go on and just take a quick look in the equities, futures, SPOOs. We are lock limit down, but I do see, I think it's on the squawk, UK 2-year yield turning negative, I think it said. We do see that we did come off the limit move at 10 p.m. Central Standard Time, only to turn around and fall right back. You can see that here. We've seen just some big moves here. Looking here on the 2-hour chart. Now, with the equities or equity futures, I should say, S&P's lock limit, they're not going to be able to open again, at least other than if the market's bid up, until the cash equity open. Let me see here. We've come off quite a bit. That's at 27.87, and I think I have that marked up on a daily chart anyway. But let's go and mark this here. Taking a look here on the daily, you can see here we have a support level that comes in here, 27.85. We've already exceeded the 50% move here. That would suggest an even deeper move because generally with fibs, if you end up, let's say in this case, you held the 50%, we saw rally. Usually the next move doesn't stop at the next fib, which is the 61%. It goes to the following one, which then would be a 78% potentially. Not that there wouldn't be some buying in the meantime, but I'm just saying the next significant pause at that point would probably be at the 78%. Just bear with me. Okay. So 60%, 1% come in 27.36. 78% doesn't come in until 25.64. But you can see here at 27.85, should see some decent demand come in here at this level. Let's see how much further we can go and push on that. Let's go on and move into the crude oil, which to a certain extent exacerbated this move. We'd actually got down to the $30 level and saw a rally. There we go. And that rolled back down to the $30. It just sat there, and finally we did go in and break lower. Coming down here to 27.40 before bouncing back. We're actually above the, for right now, we're currently above the VWAP. That may help equities a bit in the medium term. I think we'd see even more pressure if we were all the way down here, but certainly there's consequences for the companies that's even making that more difficult. Of course, obviously the coronavirus, but I mean, with crude coming down this low, it's just it's going to put a lot of companies in financial fix, to say the very least, and also the employees that would be impacted by that. It's just, but like I said, if we can get back above potentially 31.80, 32 after this fallback, that may, at least when we open up in cash equity trading, maybe that'll kind of cushion the fall a little bit and allow the market maybe to bounce a little bit. But I think in the morning it's going to be exceptionally volatile. Let's go and take a look at the gold market. You can see here with gold, we actually saw a phenomenal sell-off. I mean, look at this, from 1705 all the way down to 1655, actually 1657. So coming off almost $50 before rallying back up here, coming up here to the 61%. The 61% was just a little bit higher. Actually, it's going to come in at 1686.70. So we came up about $1 short. I was looking at that. I did see it coming up to the VWAP, but I thought, well, because of volatility, they might be able to push up just that extra dollars, but they didn't. The VWAP held like a rock on this, and you can see we sold out for the VWAP, but almost $6, and then we rallied back, and then we dipped back again. They're kind of sitting there in the middle right now. Let's go back into FX. And looking at what we have, at least on the economic calendar, which is probably the least of our worries, we did get German export numbers, which came in flat over an hour ago. And then we have European Centex index at 5:30 Eastern. I'm in Central Time Zone, so mine shows 4:30, but Eastern Time is going to be 5:30 for the European Centex index. Reuters Post is going to be for negative 11.1. And we do have Mexican core inflation coming in. Another market, the peso, that's just really screamed higher. And then we do have Canadian housing starts, along with building permits and ISM manufacturing PMI coming out at 9 a.m. Eastern. So we'll just go over the news real quick, just get an idea of where we're at on some of these stories. You can see here, look at the Aussie, just unbelievable. Look at that. The Australian and New Zealand dollars touched 11-year lows on Monday as a slump in oil prices coupled with coronavirus fears drove investors to the safety of bonds, driving yields to unseen levels. The commodity-linked Australian dollar was last down at 65.47, haven't fallen as much as 63.11, a level I'd seen since early 2009. Panic-stricken investors rushed to the safety of bonds as oil prices collapsed 30% after Saudi Arabia stunned markets with the pledge to slash prices and boost production following the collapse on OPEC's supply agreement. At one point, the Aussie yen was down 6% against the safe haven yen, while the Kiwi yen plunged to more than 7%. The Aussie has been under pressure since mid-January as more coronavirus cases emerge in China, Australia's #1 trading partner. A rate cut last week by the RBA to a record low of 0.5% further sent the currency pair spiraling. Australia has seen a worrying increase in coronavirus cases in the past couple of days, though the majority were travelers who caught the virus abroad, with only one instance of community transmission. The Australian government is set to unveil a fiscal stimulus package this week to to stave off recession. With details of the measures are still being finalized, media reported that the planned $10 billion stimulus package includes wage subsidies, cash injections for businesses. In addition, economists are widely expecting another rate cut from the RBA to a quarter point next month, followed by the unconventional monetary policy. The National Australian Bank now forecasts the RBA will adopt unconventional policy by May or June to help the economy deal with the fallout from the coronavirus outbreak, economists said in a note. The NAB expects the RAB to implement yield curve controls, they said, referring to a form of quantitative easing where the central bank sets target levels for government bond yields and buys bonds if yields fail to settle at the targets. Yields on Australian 3-year bonds hit an all-time record of 33 basis points, while those on the 10-year paper went as deep as 55 basis points. The New Zealand dollar was last down 1.4% at 62.72 after easing earlier, hitting an 11-year trough of 60.08. There have been 5 confirmed cases of coronavirus in New Zealand. So far, the government on Monday extended its restriction on travelers from China, Iran, from others by others over another 7 days. The RBNZ governor will give a speech on Tuesday about how the bank would assess and use unconventional monetary policy tools if needed. The RBNZ is set to make its next interest rate decision on March 25th. Okay, Japan warns against a yen spike as investors seek safety on virus spread. Japan's finance minister on Monday warned investors against pushing up the yen rapidly, saying the government is closely watching markets, which he described as nervous amid the global spread of the coronavirus. Taro Aso made the comment on an ad hoc news conference after the yen plunge jumped more than 3% to a day high of 101.58 per dollar, its highest in 3 years. The benchmark Nikkei share index tumbled to 14-month lows on Monday on rising fears the spread of the coronavirus could severely damage the global economy. We watch currency and stock market moves for a while. We'll examine them carefully, Aso told reporters. Asked whether Japan needs to intervene in the currency markets to stem the yen's strength, Aso declined to comment. Aso's comments came after a senior finance ministry official stepped up warnings that the authorities would watch market moves with a greater sense of urgency amid the virus fears. The spread of the epidemic has prompted heavy selling of riskier assets by investors and a scramble into assets such as yen, which are perceived to be safer havens during times of financial distress. Japanese policymakers tend to talk down gains in the currency as sharp appreciation sort of competitiveness of countries' exports and could weigh on the export-led economy, which is teetering on the edge of recession. Nervous moves are seen in the currency markets, and the official told reporters after the yen broke to 104 per dollar. The official spoke of the condition of anonymity. Senior officials from the Ministry of Finance, Bank of Japan, and financial watchdog, including top Japanese currency diplomat Yoshiki Taikuchi, will meet at 6:30 GMT to discuss global financial markets, and the ministry announced on Monday. The number of people infected with the coronavirus has topped 107,000 across the world, and 36 people have died. Japan has intervened in the foreign exchange markets in 2011 to stem the yen gains in the wake of the Fukushima nuclear disaster triggered by large earthquakes and a tsunami. Tokyo has stayed out of the market since then. Japanese officials say they are sticking to the agreement of the Group of 7 and Group of 20 economies that excess volatility and disorderly market moves damage the economy, a tacit agreement they interpret as allowing action against sharp market swings. And lastly, kind of gives us a bearing of where we're at. That's why I'm covering the third story. Generally, we only cover two. But after what we've seen overnight, certainly more than warranted. Dollar and commodity currencies trampled by oil and virus double shock. The dollar dived against the euro and yen on Monday as slump in oil prices combined with coronavirus fears to drive the U.S. yields to once unthinkable lows. Oil prices collapsed 30% after Saudi Arabia stunned markets with a pledge to slash prices and boost production following the collapse of the OPEC supply agreement. Packed investors rushed to the safety of bonds, sending 30-year yields beneath 1% and 10-year yields under 0.5%, all but eliminating what was once the dollar's chief attraction. In hectic trade, it fell 0.3 against the yen to 101.50. 58%. Actually, it fell 3%. The euro was last up 1% at 14.08, while the Australian dollar and New Zealand dollars were down close to 2% with fearful mood. It is totally wild, said Shafil Sachev, head of FX Asia and BNP Paribas Wealth Management in Singapore. This is not a train I want to be getting in front of. And how long it continues and where it goes from here is going to depend on how the situation evolves, she added. So far, the yen's rise has it headed for its largest three-day gain since the depths of the 2008 financial crisis, is up 9.4% in a dozen trading days. The gain has raised concerns amid policymakers in Japan, whether it's bad news for exporters, with a senior finance official telling authorities we're closely watching trade. At one point, the Aussie yen was down 6% at an 11-year low against the yen, while the Kiwi yen fell more than 7%. The number of people infected with coronavirus topped 107,000. And with that, like I said, we'll move into analysis. I mean, the FX market has been huge because, as Blake noted on Twitter on Sunday evening, he said there are no limits, in FX, up or down, because we're talking about the lock limit in S&P futures. So let's go and move on to the euro. We'll kick it off there. And these moves are just incredible. Needless to say, analysis goes out the board because, look, we were talking about moves at blah, 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 and it's the news is almost inconsequential because, like I said, of what we saw, with the Saudis deciding to just basically, it was, this is all prompted because, for those that don't know, Russia wasn't willing to go on and offer any cuts, and the story was that, the Saudis kind of, in a, trying to get the right word, but in a good way, kind of, really strongly point out, it was necessary. And I guess at that point, the Aussie said, screw it. The Saudis, screw it. We're going to really impose some pain. And boy, they have. To the tune of, I think I saw that they would even pump it up to 12 million barrels a day. So they are really laying it out, going all out, and giving the Russians all that they can handle. So that's where we're at right now, and that's what has brought this to where we are. You can see this level coming in at 1481. The market almost tagged 15 even, so we're going to go with that for the immediate resistance, which is 1481. We can actually, we got 1421. We got this little zone here. Let's just call it 1445, 1481. Maybe just a moment. Saying hello to a couple of guys in the chat room. So I've got got the resistance here for Good thing I did double check that. 14, doggone it. Hold on. 1445.81 for resistance. And for support, now obviously we're going to see some pretty wild volatility, not that we haven't already seen it over the next few days. So this way we have to go and keep things in check. Support is going to be right there at 1365. And boy, has this, Blake has been warning about that for so long, but boy, has this carry trade unwound. But it has unwound, but, let's be honest. It's more about the fall in U.S. yields that has driven this. So, yes, the carry trade, blah, 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 but it isn't because it unwound because there was, obviously, in part, that was due because interest rates were higher. But, that's been the forefront. The whole idea about, selling euros and buying U.S. assets, i.e. the S&Ps, which kept going higher and higher. But it's the U.S. yields and the complete collapse in U.S. yields that have really flipped the script. We were kind of moving higher in the euro, but as U.S. yields started coming under pressure, and then the Fed cut interest rates last week, and then it's just accelerated at that point. But on the upside, so we're looking here in this area, 1445 to 1481, and on the downside, 1365. Let's go and move into the cable. Well, we've really taken off here in the cable also. This is the resistance level that we have right here, which is 3166. And just beyond that is 3210. And we almost made it to 32. So once again, we're going to have to go in and put these 3166. Let's see what's here. And there's the 3166, and the 3210 just pushed a little bit higher. Compared to the moves we've seen in the euro, the cable's been very restrained. We've pushed up above the pivot, but it certainly isn't the kind of moves that you're seeing here with the euro. So once again, 3166, 3210 on the downside, it'd be right there. For moves being dipping back to 3053 will be where you find that support. And this has just been something else. It almost made it, but didn't quite get there at 62.95. Came pretty doggone close. Not that we were looking for that. But you can see we almost made it down there. We can go and take a look at it on the weekly. Actually had it marked up before 63.03. We just about made it there. That's 62.97. We would call it 63.03, but if you look on here, 62.97. Didn't quite get there, but let's go to the daily. God, look at that. Even on a 15-minute bar, we can't even get anything here. Sheesh. Not even on a 5-minute bar. So, I mean, the thing is that we dropped in that 5-minute bar 150 pips. So support's going to be 64.77. So it's going to be right now. Almost doesn't seem like it's far enough down, but 64.98. Let's go with that. I don't want it to be so close. And only putting this down like 50 pips to me seems like it's almost too close. This is where 64.36. This we can go 64.96. And on the upside, $65.70. And let's go move on to the Kiwi. Well, we almost made it to 60 cents. Same thing, we're going to have to go move into the lower time frame chart. So it's going to be 61.77. At 62.30. And on the upside, $63.11. And let's go over to the dollar CAD. And man, you can't get in front of these moves. You're really at your peril when you try and stand in front of these trains. Here was the analysis I had. Now, this was over the weekend, and we were looking. We mentioned that the market had closed over 34. Well, I can. Here we go. Well, I don't even, oh yeah, here we go. I think it's. Yeah, we finished the week above 34 with an expected major drop in crude prices. The pair should take out resistance at 35.04 with the next challenge at 35.72, confluencing with 35.58. The reason that's key is because 35, this is right where we opened. And the market was kind of sitting here, and look, we ripped up. And if you stepped in front of this train, believe me, I know because I used to do this. Going, oh, I'll take on the market right now. We're at this level. I'm going to go and jump in, but you're in a new dynamic with crude oil prices collapsing. So look, it just ripped people's heads off. And I had someone in the chat room that was talking about it, and I cautioned about that, saying, I used to do that. Oh, I see here 35.72, and I see a confluence here. I'm gonna step in. But it's a new dynamic because you're breaking out. You have to wait till, let things, settle. If, let's say, over the next couple of days or this week, finally things quiet down. Okay, then maybe you can see a pullback. You don't jump in front of the train this early. And look what happens. You get run over. And I'm not trying to be facetious either. I used to have those little alarm things. I usually don't like to have them there marked off. So resistance is going to be, even with crude oil dropping down into the 2760, we still didn't take out this area. So resistance now is going to be right there at 37.43. It's actually a little bit higher, 37.48. But look how much we've already come off. That's why I think realistically you have to take, there's a center right there, which is 37.16. And currently we've got 36.46. Support on the way down is going to be 35.72. Which was going to be resistance is now going to be support. That's what I'm saying, how this thing has just completely run over people. And that's why I caution people to don't get in front of these trains. It's that you can at different times when we're in a range, but, and especially something that's huge, we're in, not to go with hyperbole, but to go with it, we're in uncharted waters in the sense that look at crude oil, the way it's collapsed. And we already had the coronavirus, but the crude oil throws in a lot of different variables, and obviously certainly impacting dollar CAD. But you can imagine the amount of companies that will be in trouble with that fall, and the amount of employees in turn eventually that will come under pressure. It's a different dynamic when you see something like that. You don't get in front of a train like that. And I guess experience is what helps experience like being on that side and having taken those losses when trying to jump in too quick in front of a train. So let's go and move into the dollar peso. I mean, these moves are just, look at that. That's freaking incredible. I mean, I thought it would have been amazing just for us to tag into this area and maybe even get above that. Look at that. We've screamed almost all the way up to 22. We were at, it wasn't even that long ago, we were at 18 and this market was just sitting there. I mean, 18 and change, 18 and a half, but well, basically 1860. But look at this. We're above that resistance for right now. Let's just mark it right here. You see there? And we may end up taking it out because when the SPOOs open up, and if they open up low, we see a further sell-off. So we've got, let's go and move into a shorter time frame for right now. So resistance is going to be 2179. It's 2177. Support is 2109. And 2093. And let's go move into the dollar yen. Well, I'll tell you what, volatility is certainly back in the dollar and currencies. We actually have support. There. 10104. And 205. And on the upside, going to be 305 and 337. And let's go move into the cash tolerance. To me, I feel like the worst is over for the dollar because how far U.S. rates have collapsed. And I'm thinking that this is more now about where rates are at. So we're going to go right there with the support. Actually, that's finds that you'll see the touches on that. Right there. 94.47. $95.55. And let's go move into the Kiwi yen, into the crosses. Right there, 63.50. And below 62.16. Let's go 62.35. And on the upside, $64.71. Moving on to the euro yen. fared a bit better here, and we'll go right there, which is 1654. Right there, 1726. Wow. If that's not a shooting star, I don't know what is. Holy smokes. Wow. That is absolutely incredible. Resistance can be right there. 75.51. Although it's probably going to be closer right here. 75.09. 'These moves are unbelievable. And on the downside, $72.30. $71.21. Another shooting star. Look at this. Holy smokes. Trying to keep track of some of these moves. Oh, look at crude. 32.53. And this is a key level right here. Huh. 32.53 here in crude. Turn out just a bit here. 32.49. Just saw that, and that was a key level. And but already, as soon as I saw it, it's already dipped back to 32.27. Holy smokes! Doggone, just saw that. I was gonna try and grab that real quick. Figured we get a dip back. We are getting one, but anyway. Looking here at the Euro Kiwi, we'll punch it back up again here in the Euro and others. And the crude oil, I'm trying to look for some kind of divergence. I'll challenge it back again. Resistance is going to be 82.77. $81.65 before we get there. Support 79.29, followed by 78.35. Let's go to the ASEAN. Resistance is going to be 67.62. And support 66.48. And on the guppy, resistance is going to be right there at 35.78. With support coming in right here at 33.66. Resistance here on the sterling is going to be 2.01. Just go with that, 2.018. And support, break them lower. $1.988. And there we go. And I'm going to get that posted in the room. And thanks for joining us here on the European crossover webinar. And good luck trading in the day, because it's going to be a volatile one.